Hi, we have with us Mr. Vivek Doval and Mr. Amit Sharma. In the last episode, we recorded which sector to invest in to maximize our returns over the next 2 to 3 years. So, we all know the Indian market is at a reasonable price right now, but it is important to identify which sector. So, we will go through the macros of a sector, then demand tailwind, and also the valuation drop that has happened, which is varied for all sectors. So that part is important. Welcome back, Vivek. Welcome back, Amit.
Hi, Anuj. You just mentioned one thing that I would like to point to the onset. You're getting a very big discount in the Indian equity markets. It is not fairly priced, it is cheaply priced. The markets are trading at closer to about 16 and a half times price to earnings for fiscal 27. That is almost a 30% discount. And I think it is very important to get the context right. If, say, for example, in your area, you were scouting out for a house or a flat and you were getting it at 30% discount, almost never get it, right? I mean, it's a no-brainer market. It is a very attractive market. So as you start this, I wanted to, it's not fairly priced.
Yeah, but it is not fairly priced to advantage towards us, the buyers, the investor. It is a buyer's market. That's right. So what Vivek was saying, the average P over the past 10 years has been to the tune of 22.5 to 23. And today it is trading at 16.5, as Vivek rightly put. And what asset can you buy at a 30% discount? So let's get to the sector analysis. So last time we discussed the banking sector, the IT sector, the auto sector, and the oil and gas sector. Moving on to now the reality sector. Can we have your inputs on the reality sector? Our motive as investor is to identify the sector to maximize our returns. Over to you, Amit. Reality sector.
I think quite a few of the investors who are listening to this will be interested in the realty sector for two reasons. One, they all want some realty ownership in general, and two, in terms of making returns from equities. I will start as a sector. It's not a bad sector on its own. As an asset class, realty is not a bad asset class. Property is not a bad asset class. Over a 20 to 30-year period, it has given, in a very long cycle, 8 to 9% CAGR or per annum returns, so which is very good. Equity markets, they give you returns of 12 to 15%, more towards the 15% range in India over a very long period. Equity market is cheap, as Vivek was saying, and there is a lot of things going on there. Coming specifically to the realty sector, I will break it down into two parts. One is the residential and the other one is commercial. Both have different cycles. Both are working in a different, they have different drivers, and both have different long-term outlooks. So let me start with the realty at the residential side, which most of us will be aware of what's going on. Now that in itself, it is a long cycle. Prices don't go up 8% per annum. Prices go up in spurts. And then what we see is some kind of plateauing. Prices usually don't come down in India. What happens is they keep flat for a period of time. And we've seen that in 2000 where property prices were flat and then there was a rally. Recently, what has happened is post-COVID, there was a lot of buying that came about in the property sector. There was a lot of price increases that ensued in the past, since 21, 22. We saw a lot of price increases, a lot of buying, volumes picking up, and all that stuff. Now that has led to a kind of an affordability crisis at this point, because not everybody can afford, property, residential property. Actually, there are the property market. I would describe it as a K-shaped market. There is one segment which is the luxury end. That segment continues to do very well even now. Whereas the mid-income and the lower income segments, that saw a big spurt, now is slowing down. So what we've seen is the volumes have started to slow down. So we are going through a cycle. It is a long cycle. Over a long term, you will make good returns, 8-9% returns. But in the medium term, we see some pressure, especially in the mid to low income residential property. Coming to the commercial segment, Actually, that's a very interesting segment. We see not a cyclical, but a structural growth there. And factors that are contributing to that growth is the Indian economic growth. It's the increase in labor force. It's the increase in GCCs, the global capability centers, and the likes. And good quality grade A office space is more and more in demand. And this seems to be a very much of a structural trend rather than a cyclical one-off. We are actually very positive on this long term. One of the ways you can start looking at it is we initially only used to have to be able to buy a commercial property on our own and to benefit from it. But over the past 3, 4, 5 years, what we've started to see is REITs, which is real estate investment trusts, which are like a fund where you take a position where you own a portion of the building, as simple as that. So you're owning a portion of the building and benefit from all the revenues and returns from the building. The benefit that there are two kinds of benefits that come from REITs. I don't know if investors are aware of. One is you get a regular dividend yield, which is, think of it like a rental yield on a property, but this dividend yield is in the range of 4 to 5%, which is very good. You don't get that on a residential property in India. Second is that you own part of the building. So as the building price moves up, you benefit. So you may own 1/100th of a building, and which will give you all the economic benefits. So I think this is a new asset class, but a very interesting asset class, which I would say, given what we are talking about commercial real estate, which is doing phenomenally well and will continue to do so over the next 5-10 years.
And I will just add one additional point to what Amit stated. In addition to this factor that the commercial real estate is expected to do really well, from the financialization of the commercial real estate in investors' portfolio, you will see a lot of institutions investing in real estate investment trusts, which also increases the buying demand for REIT stocks in the marketplace. Now, this particular trend of actually having commercial real estate in your portfolio for family offices, for institutions, is a very, very important multi-year trend. This will further bid up the prices of REITs.
Right, right. So I want to point out one more thing when it comes to property. The fact, and I'm talking traditional property, not REITs right now, the fact that you tend to buy one and that investment gets locked in for a long period of time and you can't exit it. When I mean you can't, I mean you can't. You can't sell the entire thing if you need a small bit, and that really helps in compounding your investment. So we have all, a lot of us in India have seen that happening because you invested a block, a house or commercial real estate, and you could not liquidate it for getting 10% of it out. So the compounding effect over 15 years, we've all experienced that in India.
I think there's a flip side to it as well,
Yeah.
which actually benefits the REIT. That is, whilst you have enjoyed the compounding effect on things, what people who are property owners have enjoyed the compounding effect, it ties up their liquidity. REITs, you get the compounding effect without tying your liquidity. So if you wanted to sell out of your portion of 100 shares, you wanted to sell 5 shares or 10 shares or 20 shares because you needed it for an emergency or for some other family need, you could probably do that. So this asset class has got all the qualities of rising in India as investors seek to diversify their portfolios from not just real estate they own to kind of real estate which allows them to have flexible ownership and quick liquidity.
Yes, yes. And we have seen, stock REITs like Embassy and Mindspace and KRT giving around more than 18 to 20% return over a year, which is an alpha over the Nifty index. So one is that, and SEBI has actually put in a very transparent regulatory on REITs, wherein which they have to distribute 90% of what they get.
Adding on, Anuj, that this is not an asset class. It may be new to India. We have tracked this for 15 plus years. There are REITs, like 40, 50 REITs in Singapore. There are several, 100 REITs in the US, which are listed, which work, and, which is as an asset class. And it points to what Vivek was saying. You've got institutional investors, family offices, new kind of investment demand, which comes into them. and sticks and stays invested.
And that actually bids up the price of these assets, which is often referred to as yield compression. So 5% actually might be very attractive yield, but for institutional investors, it is extremely attractive yield. So as they actually participate more in the pricing of this, the dividends might gradually grow, but the prices rise very fast and you have a yield compression. So, apart from the kind of fundamental earnings power of the doing well, that is the rentals increasing year on year, you may also see further pricing appreciation in the NAVs, net asset values of the yields, because of yield compression, and that adds to your, as you were
Yeah.
mentioning, excess returns or alpha.
So since you mentioned that you've been observing this REITs in Singapore and US, can you give us how they have performed there? Two aspects. One is the yield. Has the yield been more than the inflation? Second is increase in NAV value, which got benefited, the investors got benefited from. Can you give some inputs on that, please?
So there are different types of REITs. You've got office REITs, you've got warehouse REITs, you've got data center REITs. So it's like a very varied industry and it's very well developed. In terms of the return profile, actually, their dividend yields are typically good, 6, 5, 6%, depends on, what companies. More importantly, the dividends keep growing because you've got rental increases embedded in these contracts. So that's one of the factors it kind of protects you against inflation. So to answer your question, it does. If I look at the overall return of these REITs, they move in line with the property prices in the area as well. So it's best of the both worlds. You get an income and you also get the price appreciation and you also get the liquidity, which is what Vivek was saying. Like if you really want to get out and tomorrow you don't want to be in this, you can get out on the day.
It's been a very stable asset class around the world. I mean, it's been highly institutionalized in various developed economies and is a well discovered asset class. And it has not posed any systemic risks so far in the last 20 odd years that we have observed. It's gone through its highs and lows with the property markets. So it's not always that the property prices rise. I mean, there are cyclical downturns as well when there are overcapacity issues, etc. But as far as the DPUs, which is the dividend per units, right, have generally remained stable or increased in time for high quality, good REITs. It has never been a problem.
So, reading into that, would it be fair to say that if we were to analyze a REIT, we should look at what are the long term, how long are the lease agreements of that REIT with the occupant? Because one is the annual growth of rent or lease that it has signed. Second is when an occupant generally leaves, the next occupant tends to give a around a 15% higher rent and lease. So what I'm trying to ask you is that when we are analyzing which REIT to identify, should we look at lease agreements as in the average longevity of their agreements? Is that a way to look at
Maybe
it?
I'll start with that, Anuj. There are multiple factors you need to look at. It can't be just one factor. As you know, our approach is multi-factor approach. We need to look at multiple things. The most important thing is really the asset. What is that asset? The underlying building. And equally important is who's the manager of the REIT. These two factors are the key. Apart from that, other things like, how long are the leases? Those are cyclical that can change. But, typically what happens is, if it's a good asset, it will be leased out, even if the lease is ending. Sometimes you may have a gap, which may lead to lower returns. So, these are factors you'll have to consider each and every REIT according to their, own merits. But the most important two factors is the quality of the asset itself and the quality of the management of the REIT. These two factors we've seen in multiple cases in the past. If these factors are not aligned with you, you may not end up making money.
And the point that Amit mentions in way of the investment manager for the REIT is exceptionally important. Most of the times the investment manager of the REIT is actually the construction company, developer that develops that particular asset. So they know a lot about it. They make high quality assets. They know about, maintenance issues, logistical, infrastructure issues, etc. Often of these assets are being managed by a different arm of these property companies, the investment management arms. But if these assets are looked at well, they're well managed, they're upgraded, refurbished, redecorated from time to time, they tend to actually hold their value for longer and be more relevant.
Yeah. So that was very interesting. Investment into reality can be broadly classified into three different ways. One is the traditional buying of the property. Second is the REITs that we just spoke about. And third, of course, is the equity of the developer that is listed. And I would like to point out here that the drop in PE from its 52-week high to current in the sector, in the developers equity sector, has been close to 30%, rather more than 30%. From 51 points, it has dropped to 35.9. So this sector needs to be looked at, which we have. And just to summarize, and please correct me, Amit, Vivek, if I'm wrong, to summarize what we've discussed is, if it comes to traditional buying of the real asset, the commercial sector is an interesting sector to look at. The growth has been nice. When it comes to the housing sector, it is the urban and the premium housing sector. Then comes the REITs. REITs is definitely interesting. The growth has been fine, as in the NAV has been fine, and the yields have been above inflation. It's capital preservation. It takes care of that. And the third is the equity into developers listed companies, that I have informed you that it has come down. The P has come down from 51.7 current 35.9, which is a 30% drop. So this is an interesting sector to look at. Amit, would I be right to say that? Vivek, any inputs on that?
I think, absolutely, as with the rest of the market, which is corrected by closer to 30% in terms of valuation, from closer to about 22.5 times to 16.5. For the overall market, the real estate sector has corrected by roughly the same level of 30%. It's a very attractive entry point to get into the real estate sector. And, if we expect a pickup in corporate earnings over the next few quarters, we should expect a very strong re-rating that happens in this sector as well.
Great. So moving on from reality to FMCG. FMCG has been an interesting sector since since ages, and now we're going to discuss how do we look at that sector through the lens of the macros, the demand, and the valuation drop. Vivek, if we could get your inputs to decide whether this is the sector to invest in to maximize our return over the next 2 to 3 years. Over to you, Vivek. FMCG sector.
Yeah, Anuj, this particular sector is always the bread and butter, the staple sector of the economy. It always is attractive. It has always remained attractive. I think the entry points that it offers to us at this point for companies like Hindustan Levers, ITC, Dabur, the corrections that we have actually seen have actually made the sector fairly interesting. I would probably add Asian Paints also to the same bucket, though it's not entirely, FMCG, but in the Indian context, it is seen very close to FMCG companies because of its structural demand and its consumption theme that plays itself out. Valuations are extremely interesting. There are structural drivers in way of, increased, the GDP growth remains fairly strong. We expect a growth to really pick up in the economy going forth, despite the Iran war in the Middle East, which may have some negative impact to growth. But despite that, we expect growth to be really robust. We expect credit growth, consumer-facing sectors also to be very strong. Offsetting it could be some factors that may, cause some issues. We actually have an effect which is known as the El Nino effect, which is a weather-related impact which could lead to slightly drier and hotter conditions in the world this year, which could have an impact on the monsoons. This may have an impact on agriculture and farmer incomes. We would think that some of this would be offset by increased subsidy from the government, but all the same, the farmers could suffer. So this could be negative for consumer staples, and may shave off some growth. But on a holistic picture, we still expect the growth, both in volume and pricing to be fairly decent this year. And with the attractive valuations, it offers a very, attractive entry points for this structural. This kind of sector, the companies in this sector, the ones who dominate, are fire and forget companies. You just buy it in your portfolio and leave it forever.
Right. Amit, any inputs from your side?
I just want to add one more thing, which is, and I agree with all what Vivek said, is that there are times when you get an attractive entry point because of certain reason. Like in some cases now, because oil prices have gone up, input costs have gone up. People start worrying, oh, these companies, oh, whether they'll be able to pass through prices, blah, blah, their earnings is going to take a hit and all that. What we've seen through cycles is the best companies are able to pass through prices. All these fears, proven wrong eventually. So whenever you get a great entry point like this, because of some reason, you just take it.
Right. And let me also inform that the 52-week high was at 45.9, and the current PE of this sector is 34.5. So that we can have an upside of minimum 25%. So that kind of layers what you guys said exactly. So that was very interesting. Over the past two episodes, we have gone through various sectors: banking, IT, real estate, FMCG, and identified which are the sectors that we can invest in to maximize our return over the next 2 to 3 years. It was great having you guys with us as usual, Vivek and Amit. Your inputs are so beneficial and they help us decide what to pick. Thanks a lot, Vivek. Thanks a lot, Amit.
Thank you very much,
Thank you.
Amish.